Welcome to the 2023 year-end commentary. My name is Lorenzo Peterzani. I'm one of the portfolio managers at Westmount Wealth, and I'm joined by Matthew Evans, one of the other portfolio managers on the team. As you know, the stock market is no stranger to volatility, and sometimes it can feel like a rodeo, a bit unpredictable and a bit wild. And last year was no stranger to that kind of volatility. So we're going to talk a little bit what kept us in the saddle last year and start with a bit of a recap of what happened in 2023. So Matt, why don't you give us some perspective on what happened last year?
I think before we start reviewing what happened in 2023, let's take a look back at how 2022 finished. As many of us know, interest rates and inflation moved quite dramatically in 2022, and that sent most asset prices down. So that's both stock and bond markets. So as a balanced investor owning both of those asset classes, it ended up being one of the worst years in history for that balanced investor from a portfolio standpoint. So coming into 2023, it's no surprise that most of the news headlines were quite pessimistic.
And we saw some of those fears manifest as we started to see regional bank failures in the US. In particular, we saw three banks, Silicon Valley Bank, First Republic, and Signature Bank, needing to be bailed out or purchased by another entity. Luckily, the federal regulators in the US stepped in and backstopped deposits with a guarantee, and that really helped limit the contagion and settle the markets.
So throughout the summer, we actually saw the resilience of the US economy driven by a strong labor market. So we had unemployment sitting at the lowest level in about 20 years. We also saw the strength of the US consumer. So despite a dramatic increase in interest rates, US consumers have the unique ability to lock into a 30-year term mortgage, unlike in Canada where we're typically on a 5-year. So as interest rates fell during 2020, most of those consumers locked into record low rates. So as rates started to move the following year, they were unaffected from a mortgage payment standpoint, very different than that Canadian borrower. So this combined with excess savings built up during COVID lent to a very strong US consumer and US consumer spending. In addition, we saw the US inflation backdrop start to improve. After a dramatic move in 2022, where we saw inflation peak, we started to see inflation come down to that Fed comfort zone of about 2%. And this really led to quite a pronounced rally throughout the summer in the financial markets.
But the year had one more big surprise in store for us, and that was really the steepening of the yield curve at the long end. So when we talk about inflation happening over the last 2 years, starting in early 2022, what the Fed Reserve in the US and the Bank of Canada did was to increase the overnight lending rate, or the Fed rate, which is basically the cost at which the federal government lends money to banks. And that really impacts the short-term cost of borrowing, generally in that 1 to 5 year range. What it didn't impact as much is that 10 to 30 year bond rate. And that stayed pretty sticky actually for the better part of a year and a half, with a lot of analysts wondering when the long end of the yield curve, so to speak, would steepen. And we finally saw that happen in a pretty dramatic fashion in September and October of last year. And again, that spooked the equity markets as well as hurting the bond markets. But by November, we saw the Federal Reserve sending out some language. By December, the Federal Reserve sent out some language indicating the rate hike cycle was probably over, and that really seemed to calm the markets, and that really led to a broad-based rally in the last 2 months of the year. So despite the year starting off with very negative predictions, we ended up seeing a reasonably good year for investors in 2023. So Matt, what happened last year in the indexes?
What we've got in the table below is not only the 2023 year-end numbers, but also, for comparison purposes, the 2022. So what we saw in 2023 is a strong rally across all assets, so both stock and bond markets finishing off with some pretty spectacular results. So if we're looking at the Canadian bond index, finished up about 6.71, while the US in local currency finished up about 5.77. If we now take a turn to the equity side, We've got the TSX composite finishing up, pretty strong 11.75. The US market finishing up 26.29, although that wasn't really a broad rally in all assets in the US. It was really contained within, a few names, about 10, mostly related around the artificial intelligence trade. And then if you take a look at the NASDAQ, which we have highlighted here, it finished up a striking 43%. Now, what we're trying to point out with the 2022 returns is that although the index finished up 43%, it finished down a negative 33 in 2022. So one may believe that they're in a positive position if they had held the index over that last 2-year period. However, as we know with the loss, the math behind a loss is if you fall 33%, to get back to where you started, you actually need your asset to go up 50%. So although the NASDAQ finished up, it still is short on that 2-year basis.
And this really speaks to a big part of our core philosophy as advisors, which is the importance of diversification, the importance of trying to mitigate large swings in the portfolio. Because as we've seen last year, in the last 2 years, especially with the US NASDAQ index, the bigger the loss, the more difficult it is to recover. And the traditional portfolio diversification that we've been used to over the last 30 to 40 years, which has been really mixing two predominant asset classes of fixed income and equity, tends to work most of the time. But unfortunately, where it fails is often when you need it the most.
Exactly.
Think 2008, think 2020, often in 2022, obviously, when the equity markets are down, fixed income is being dragged down with it. And even though you can try and diversify within those asset classes, really, if you take a look at how pensions have evolved over the last 30 years, they've realized the importance of adding in other asset classes. And we're not just here to, reinforce the fact that, we like to diversify beyond just stocks and bonds into alternative investments, but it's just really the importance of trying to spread that risk out, over time. And so, as we talked about 2 quarters ago, it's not just about building a 2-cylinder engine. If you can build 6 or 8 or more cylinders to your portfolio, it better helps protect you in a down market. If we had a crystal ball, there would be no need for diversification. And as we can see, as we've seen today, the markets can be incredibly unpredictable. Most major financial headlines and news sources were predicting a very difficult year for 2023, and it turned out to be a reasonably good year for investors. So really the key takeaways, as always, is trying not to let our emotions get the better of us, even when we see volatile markets, staying invested and having a prudent diversification strategy that maybe looks beyond just stocks and bonds to help mitigate some of those downward trends in the markets and smooth out returns over time. That's it for the 2023 commentary. Please reach out if you have any questions, and we'll see you next quarter.